available.
This conference will now be recorded.
This meeting will be available on our resources website for those that want to have another look later on. Okay, we have the online presentation to start off with. I'll let someone introduce the speaker in a minute. I guess speaker for tonight, and then we have a local members here in the Adelaide venue. We have our own meeting with some further discussions about the global indices and so in the sectors. So without further ado, I'll call upon Peter Holsworth to introduce our guest speaker for tonight. Thank you, Peter.
Thank you, Harry. Okay, so Braden Gardner, he followed his father into the financial industry as a broker in 2002, working for Sonray and RBS Morgans as an equity advisor and in wealth management. Then in 2011, from then on, he's been a private trader, trading virtually everything that he can lay his hands on: futures, options, forex, CFDs, and equities. And during that time, he learned about technical analysis and, more importantly, the psychology that was consistent with the way that he wanted to operate. And in a nutshell, he leans heavily towards momentum trading using multiple timeframes. So then in 2015, he teamed up with Davin Clark, who most of you would know, to provide a professional service to other traders. And that was in the form of a website called Trade Setup. And that's was going until towards the middle of, a bit after the middle of last year. And recently, he's now started a free website service called tradethestructure.com, which has an enormous amount of educational material for both new and experienced traders. In amongst all of that, he's been developing a couple of strategies, a short-term one that has a very high success rate, and that's one of the things he's talking about tonight. At a personal level, I've known Braden for 3 or 4 years via the Trade Setup service that they were operating, and that included weekly market summaries and advice on specific stocks. And the thing that particularly appealed to me was that the advice that he was giving was always consistent and absolute, and there was a total honesty. If he had any losing trades, he would fess up to those, and they were all included in the portfolio, the theoretical portfolio that he and Davin were running. For those of you that were here 2 years ago, this was actually the last time that Braden flew over to Adelaide for a face-to-face meeting in April 2019. So it's great to have you back again, Braden, and thank you very much for giving us the talk tonight. So with that, I'll pass it over to you.
Thanks very much, Pete. That was great. Make me sound like a wizard. So I'm always happy with that. So it was good. It was good coming over. It's actually it's more convenient for me doing it online because I can just sit in front of the computer. And I finally get to talk to some people. So normally I've got my head in the computer and typing away on our Discord channel and bits and pieces. So it's good to get in front and do another presentation. So what, as you probably all know, I'm going to talk about a few things tonight. It's basically my style of trading and a strategy that I put together probably recently on a new website that I put together, Trade the Structure. You'll see those details on the screen there at the bottom. And the website's right in the middle there, tradethestructure.com. Free to jump on, it's all free. The idea is just to get, people into the room and a bigger group together, bigger community, just to help them learn trading, and it's not just about teaching what I do, it's about everyone finding their own feet. I guess everyone trades differently, so it's good that what I talk about now, if you can take something out of it, that'd be great. Everyone, like I said, everyone trades differently, so you might find that it doesn't suit you what I do, but you might find that this is something you could be looking for. But either way, I'll try to explain exactly about the 5-minute trading day and the 3-candle entry setup and the price action I use for trading. So I'm essentially just trading price action. Now, can you see my mouse on the screen there? Is that okay? Is that coming through? Maybe not. No. All right, we'll just kick on. So, who am I? As Pete mentioned, I followed my dad into the industry after finishing my engineering degree at Monash. After that, I went overseas for 2 years to Japan, and when I come back, I was floundering around for a bit, and he said, well, why don't you come and work with me? And it started off trading options. So really, options are probably one of the hardest things to trade, and that's where I started. So I was sort of starting in the deep end and working my way backwards to futures, then trading shares and CFDs and bits and pieces. So traded everything. I traded bonds quite a lot when I first started out as a broker. So that was the original part, just before I got to full service equities at RBS Morgans. So after that, after I spent only a year there, it wasn't full service equities was different to what I was doing prior to that trading. I like the trading side of it. I didn't like just straight out investing. And when you're doing full service, you've got everything there. You don't really have to think too much about it. You've got your analysts and what they're recommending to buy and things and bits and pieces. So I lasted about a year there, and I thought, look, I'll give it a crack. Try trading for myself, and that's when I hooked up with Davin. It was about that time, and I was learning from him. So he was basically mentoring me at the start and mentoring the last few years as well, along my journey anyway, and it's been really, really helpful. So what I always found good with Davin, he explains it really well to me. So hopefully I can pass it on to you guys, explain what I'm doing and what I look for and what I look for in price action. So yeah, like Pete said, I love my technical analysis. I just look at market structure, and for me, it's about psychology, and that's what suits me. That's what suits my style. So psychology of why people do this, why people do that. And the good thing is, when you're looking at technicals, as opposed to saying doing fundamentals, you might do, it's different for each stock, and it might be different when you're looking at shares as opposed to bonds, all the different things. But if you're just looking at technicals, to me, the herd mentality is the same across the board. Everyone does the same sort of things for the same sort of reasons, whether it's fear, greed, whatever it is. But you can see that. I like to feel that I can see that in the chart, and I know what I'm looking for, and that's what it's sort of based around. So now what I do is just work with Davin. He's over in Dubai at the moment, and we work in a company called Trade Direct, or tradedirect365.com.au, and now td365.com. You'll see on the screen there. So that's what I'm sort of heavily working with, and doing my own thing on the side as well. So really, all I do apart from that is spend my time trading, talk to people, help them out, try to do pass along some education and bits and pieces. So last thing on that list is war stories. I know everyone loves a good war story. So just a bit about when I first started trading. Originally, I got into the market, and what I was trading, the biggest trades I was doing was pretty much when I started. So I was fairly green. So when I started, I got on the night desk. You do that for a couple of years, you learn the ropes, and then you jump onto a desk and you build up your client base. Now, I was lucky enough to be handed some of my boss's big clients. So at that time, I was all new, and then I was trading bonds. So at the time, I was trading the 10-year Aussie bonds, and I don't know if anyone knows, I was traded them, the futures, and I was trading crude oil options. Now, I traded bonds, I traded about 300 at a time. So every minimum tick it was moving, I was winning or losing 50 grand. So if you're going for 2 points, it's 200 grand swings. So for me, when I was new, I was watching every tick, every trade that went through. I was just staring at the screen, watching the depth, all that sort of stuff, and just praying if it went down and rejoicing when it goes up. So that was me at the start, and I sat through when I first started crude oil options. He was trading a certain way, and within the first few weeks, I nearly crucified myself trading about 300 contracts, like I was saying, options, and they basically, I was right up to the last night when just before expiry, and they were flicking in the money, out of the money, in the money. So I come from 3 cents, within 3 cents is triggering basically a massive loss. And I got lucky enough to lock away 9 grand. And basically, once I turned the computer off, 4 or 5 in the morning, I was never going to do that again. So I changed the style I was trading those, and actually worked out really well for me. So that was some of the biggest trading. And then obviously trading for myself, I don't trade that size anymore. That was for basic clients, a bunch of clients. So yeah, that was a real eye opener to the industry. So the first thing I'll talk about is the 5-minute trading day strategy. So Pete knows a bit about this. He's had a bit of a crack at it. It's something I've been doing for probably the last few months. You'll see since August last year, I've been following that and just cataloging all the trades, collating those onto a spreadsheet. Any trades that I did, there's some that I did do, some that I didn't do. I didn't do every single trade, but I've gone through, fine-tooth comb if you did every single trade that was available. These are the kind of results. Now, It's actually not up to date. I've only got to 23rd of last month. I've got to update that, but being on holidays, it was kind of hard to do. So the 5-minute trading day, as it says, although the results, we go to the next slide, as it says, the idea is that it should only take you for any product. So I trade essentially the Hang Seng, which is that's the Asian market session. I think it kicks off at 11:15. That's Sydney time. So what that's probably half an hour earlier, I think, for you guys. 11:15 is the actual futures market kickoff, and the idea I start trading it at, it's whether you're going to trade it or not will be at 11:30, so 15 minutes later. Also do the DAX, which is the German index, and the Dow, the US. So you all know those indices. The DAX has an hour of the pre-open, so from when the futures open, the futures market opens, not the CFD, but the futures market, to when the index opens, the underlying index, and all the stocks start trading. That's an hour. And the same with the Dow. So it's just when the stock market opens is that area of time that I'm interested in, and literally you can jump on 5 minutes prior to the opens for each one of those. Take a look, set up your levels, and then just wait to see if it kicks off or if it doesn't. It's a one-to-one trade. And as you can see, the strike rate, it's come down slightly at 80%, but its strike rate has been hanging around between 80 and 83%, depending on sort of the run I've had or whether it's had a couple of losing trades. But you can see all the stats on there, how many trades it's done, the strike rate there. The requirements for it is just essentially using a tight fixed spread broker, because the tighter that CFD spread, the better for you, okay? And that's where TD365, that's the reason why we use that one, and the reason why I sort of based all this around. They're the tightest fixed spread broker. Some you'll find IG, others, they do, when the proverbial hits the fan, they do widen their spreads. Well, they can do it quite substantially. I remember trading the Hang Seng at 12 pips, 12 points for the spread, up to 14 when it was melting down. And I think we kept ours at 5, so it's always at 5. So it's that's money in your pocket essentially. So that's what you need. That's the idea behind it. 5 minutes a day, like I said, you can log on just before, which we'll go over the trade in just a moment. You either trade it, you only give it really a 5 minutes to work out, or 5 to 10 minutes to work out. If it doesn't, turn your computer off, you can walk away and wait for the next trade. And it's basically, there's nothing much to it. The idea is just built around stop hunting on the open. I don't know if anyone knows what I'm talking about, but where markets go searching out stops, searching out an obvious key level where they'll flush out some stops. We're just trying to take that little rush, take the 10 points on the DAX and the Dow, or say 30 on the Hang Seng. Sometimes it goes a lot more, but that's all we're interested in, a one-to-one trade. You can check out more information on the website. Here we go. Now, this is an example on the DAX. So we've got the open here, the pre-opens at 4 p.m. and then the market kicks off, like I said, at 5 p.m. And we're looking at that 5 minute candle. Sorry, that first 1 minute candle. So we're trying to get the high and the low of that opening range. That's pretty much it. And you want a clear high. You can see in this example, it's got a clear high up there where it's traded up there, backed off a bit, traded into new high, and then backed off. Ideally, that's really good, because you know what's happening when people are selling it. The stops is going to be above a certain level, and it's generally that level there. And there's going to be stops below. So the market will generally, when it opens, the futures will flush both ways. It could flush both ways, or it could just take off in one direction, or it could just flush and come back again, come back into that range. But we're only looking for that quick spurt of, I guess, trades, or those stops to go off, or whether it's going to start picking a direction there. We're just looking for that 10 point. So we're basically, you enter your trade in. I could just whack it in a few seconds before the market kicks off at that 5 p.m. time, and then put my order in above and below, and then with your automatic entry, your automatic profit target, and your automatic stop, everything's in one hit. It's either going to work or it's not. And you can see, like from the stats I said, it's at about 83% now at the moment. So another example on the Dow, you can see that the opening at 10:30, and then it kicks off at 11:30. The index opens, so that's what would be happening tonight. You see the market can sort of bounce around there, pop up into that opening range, sort of produce those highs, produce a low. You mark them up 5 minutes before and just sit there and wait. If it does kick off a minute, if it takes out the high a minute or so before, I don't trade it. I'm just basically waiting for it to wait for that candle, because I think it's going to kick off right at 11:30, take out the stops, and then either continue or back into the range, and hopefully that's enough to give my 10 points, which you can see on this example. But basically, I think it made my 11 or 12 points on this example. So that's all we're after, and it actually turned around and reversed and went straight back down and took out the low side as well. So rare that it happens both sides, but it can happen. Another example just on the HSI, the Hang Seng. So like I said, it opens at 11:15 a.m. and then I'm watching it about, I'm actually on the computer then anyway watching it, but generally you only need to set 11:25. You can log on, have a look at it, set up your levels, get the opening high, opening low of the range, and mark it up, and then you just jump on there.
Brayden, can I interrupt you for a second?
Go for it.
Just to, first of all, to remind people online, if they got any questions, to put them in the text box. And two, I guess we will have questions as we go. I've got one specifically when I'm looking at your charts. I'm not quite sure if I missed it, but what is the time frame of the chart of the bars we're looking at?
Okay, good. Yeah, very good point. It's 1 minute. So I'm only ever trading off the 1 minute chart for this entry, especially on the Hang Seng because it's only 15 minutes. You could trade off the 5 minute, but I'm just looking at the 1 minute to get as much detail as possible.
Thank you.
All right, so that's the Hang Seng, same sort of style. You just got to mark up your levels and away you go. So that's basically the strategy in a nutshell. There's obviously a lot, there's more to it, and I've got PDFs, all that sort of stuff set up. If you jump on to the website, you can just get on and request that. So a few stipulations, but you'll see everything over the website there. Now, into this more of price action and what I look for. And this is what I'm really starting to build towards, the price action, and then we'll build towards that setup that I was talking about, the 3 candle setup. I call it the 3 candle setup, but I call it also, which we'll talk about, HH2, which is a high 2, and an LL2, low 2, depending on what I'm trying to trade or where I'm trying to trade it. Now, like I said, I trade price action, first and foremost, because that to me tells me the story. It tells me whether, with volume, what people are doing, if they're defending a level, if they're starting to buy at a higher level. To me, that's that's a key point. Starting to sell at a lower level and you're waiting for it to go up, it's probably a heads up to get out. Things like that. So you really want to, take into account not all the nuances, but you want to take into account your levels, what the price action is doing, because that's essentially I'm reading psychology for it, and I'm trying to base it around when there's going to be an expansionary move, okay, which we'll get into a bit later on as well. And to me, it's the same for shares, futures, FX, CFDs. Now they could all trade slightly differently, but generally it's the same sort of process I'm looking for. Okay. I always define my key levels, so I'll go through the process of, if I'm going to intraday trade especially, defining my key levels and trading around those key levels, those key areas where we expect action and reaction. Now, understanding why they're key levels is very important, I think, because there's going to be times when you could take a breakout trade, okay, and it's just going to be a washout and it comes back into a range. There's times I would take it and there's times I'm not, and there's different ways I might attack that trade. Okay, if it's a breakout trade, I would be more inclined to let it break out, retest it. If it retests that zone and starts to hold, I might go long. For example, if it's a breakout through a resistance level, and if it's a breakout through support, it's just a reverse. And there's times when it can break out and come straight back into the range, because it's like the 5 minute trading day. They're just going to stop hunt. Okay, and you've got to. It's not super hard to figure out, but it's just a matter of being patient and letting that price action start to show itself, start to uncover itself, not start to chase the market. Okay, so that's what I'm looking for. I like to say I'm trading in the known rather than the unknown. Sorry, I'm trading in the unknown rather than the known. What I mean by that is if it moves well underway, okay, it's quite clear. That means everyone knows about it. And that means, to me, the risk reward becomes skewed. Okay, it's higher risk to reward, because if you've got 100 people willing to buy something and you're trading in the known, it's more like 90 people have already positioned themselves, and you're waiting for, if you get in, you're waiting for 10 people to hopefully move that enough for you to make a good profit, which is a low probability trade. Does that make sense? So when it feels the most uncomfortable, the most difficult to trade, it's probably the best time to trade it. As long as you're on the right side of the market, of course, because that's where the biggest payouts are, and that's where the least risk is. The risk to reward is skewed in your favor. Okay, and what I'm also trying to analyze in price action is the fuel for a move. Okay, so if the market's come down quite hard into support and it's been trending down quite a bit, and it starts to hold up, you know that everyone's been selling into that support is potential fuel to drive it back up again. And if you're getting a nice and early and they all get out at different stages on the way up, you can get a nice risk reward trade on your hands. And if you don't get it right, you're not risking much. If you do that over and over again, you've got a bit of an edge to it. That's all you're looking for. If it's it's only 50% right, 50% wrong to trade that style, all you need is a 1.5 to 1. Even a 1-to-1 trade taking out commission, but 1.5 to 1, you're making money, okay? But generally better than that with the payouts when you're trading in the unknown area, okay? and like Pete said, all I'm really trying to do is identify momentum. So I'm trying to identify those times when it's going to go into expansion. I don't want to trade in contraction. I might have to trade that a different way, which we'll talk about in just a moment. Price action, building the picture for the market or for market buyers. So you're always trying to work out what I'm always trying to do when I come to the market fresh in the morning. I generally just trade intraday, or I have stock positions, share positions. So when I'm trading intraday, you come in when you've got a clear slate, and I'm trying to build my levels. I'm trying to pick out my levels where I want to trade, where I think the most action is going to be, and not only where it's going to be, but where it could go to if I'm going to get into a trade. If I tend to get in late and it's starting to trend and I'm somewhere mid-range, if there is a setup to go long and it's going up, if there's enough fat in the trade for risk reward, and I think it's going to go to that resistance level where it's a key, it's quite an obvious level, I can still trade it. I don't have to trade it off a key level, but I'm going to have to trade it off quite a high probability setup. So all that sort of stuff I'm marking up on the trade. Like I said, markets go from contraction to expansion. You might say expansion is when it starts to trend. When you get a pullback, that's a contraction phase. The contractive phase might be on a weekly. If you're trading off a daily, it might be, on a 30-minute chart, you're looking at when you're trading the trend up on a daily, if that makes sense. So if you're trading up on the daily chart and it's just a trend up, it might be 5 or 6 green candles trend up, but you're looking on the 30-minute chart, you're trading off that. You want to trade it when it has a bit of a pullback, it contracts a bit, and when it goes back into expansion, you want to start trading that phase there, okay? And you ideally, you trade them differently. So I'm always looking for where the phase of the market is, whether it's contraction or consolidation or expansion, okay? And you might have to trade those each differently. I tend to keep out of contraction. I may trade that if it's on a big enough scale. I don't really trade consolidation as much because they're sort of range-bound things. I like that expansionary phases, and I find, every day there's more than enough of those expansionary phases where I can jump into and try to make a buck. So when the market is expanding, that's the momentum play. That's what we're looking for, okay? And I look for the anchors for a move up and down, which we'll talk about in just a moment. And that's where I base my risk off. And I'm trying to trade nice and early when I think it's going to go up, when it's going to start to produce a new anchor if it's trending up. And I want to base my trade around that with a certain entry, which is generally the 3-candle setup. And I'm trying to hold my risk below that anchor, because if I do get it wrong, I need to be proven wrong. I don't want to be, I know some people might trade a certain dollar risk. Now, if you tend to buy at, say, $1, for example, it's breaking out at $1, and that higher low, or the anchor would be at 70 cents. Now, if your dollar value risk puts you between your entry and your anchor level, you could ideally get stopped out but not be proven wrong. Okay, so if I'm trading, especially for shares or CFDs, if I'm trading that way, I would always put my stop below the anchor or below where I'm going to get proven wrong, and make sure to adjust my volume accordingly. Okay, I won't ever trade the same volume for every setup and just hopefully I don't get stopped out, because I think if I'm reading the market properly, I'm trading in the right phase with expansion, and I'm trying to get into nice and early with the momentum. I don't want to get stopped out when it goes on and I see kick on a couple of bucks, it goes from $1 to $3, and I'm sitting there, I've got stopped out for a 30-cent loss or a 20-cent loss just because I put my stop in the wrong place. Okay, so that's why I think it's important to know where your anchors are and how you define them, where you define them, and know what your bias is as well. Okay, when we talk about trading charts, the last thing on the list there, trading charts is essentially what I'm trading off. So intraday, it'll be off a 1-minute chart. My anchor chart is generally the 5 minutes. So I'm looking for those 5-minute expansionary moves, or when it's a 5-minute move off a support level, and I'm trading it from a 1-minute chart. Now, it doesn't always have to be just those two. You could be a daily and a 30-minute chart. You can trade off your anchor chart could be your 30-minute for your key levels, and you're trading off a 5-minute chart. It's whatever suits you best. I like the action on the 1 minute, and I've tended to got used to that. I like to be in and out and then watch and then get in and out. I don't tend to hold it for massive moves. And that's probably one of my downfalls, to be honest. Missing some of the bigger moves. So one of the key concepts that I'm always looking for. Any questions, like I said, just ask them as we go, because there might be a few things I skip over quite quickly and it doesn't make sense. Just whack it into the chat and I'll be able to see it there, or we can go over it a bit later on. So anchors is a big thing for me, and you'll know it. Everyone knows the Dow theory, I'm guessing, if you've been into it for a while. And that's what we call anchors to a trend, okay, whether it's up or down, or anchors to a move. Now, you might get phases like you'll see in the green, it might go up. It's not always going to be clean, okay, it might start to go down and hold a lower high, then turn around and retrace on you. So I'm tending to, you know, if it gets a bit extended, I'm looking for 2 moves back as in a pullback, and then for it to expand down again. But it can be any manner of things, but you're looking for those quite obvious levels where you've got these lower highs. You can see in that shaded blue. So when the market first pops up and it takes out the low, it makes a new low. The anchor is that light blue area. When you get it to sort of that pink area and it starts to retrace, when it starts to confirm, it starts to get within about, you know, a few percent of that pink line again, the low, your anchor's moving down. So you try to trade it, and that's how you try to follow a trend as best you can. Okay, and that's why when I do trade, if I can get onto a bit of a trend, I like to all in from the start and try to take a quick profit, take a partial exit, maybe take another one, and then just try to leave that third one for running as much as you can. Okay, and try it, because you don't want to cut it off just in case it keeps going. I mean, easier said than done. Today I made about 80, 90 points and then cut it off and win another 90, 100 points. So, you know, and I really shouldn't have cut it off. I was just eager the first day back trading. So that's what we term as our anchor. You might say, like I said, Dow, lower low, lower high. And a trend up is a high, low, high, 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 low, high, high, and the reverse for a trend down. I just term them as anchors. And that's how I define my trading. When I'm trying to, the pullback, it's when it's coming back, and when it's expanding down, what we see in the next slide here, when it's expanding down in red, that's an expansionary phase I'm trying to trade with. You don't know how far that's going to go, but when it's trending, you're going to get that pullback in green, or that contractive phase, and then expansionary phase down. And we're trying to trade that expansionary phase. And a key thing that I do look for is what we term shoulders, because I think it's a big heads up. You get that initial move. If you can see my mouse, especially on that middle area there, you get the green move up, and then you get that first move down. Now, it's not 100%. I'm not saying that every time you get that first red move down, it's just going to continue down, but people will feel the pressure. If it starts to break a high low, okay, this is your pullback. You've got this little high low, the last high low in the pullback. Once it starts to break that, it's starting to change trend, and you start to go into that expansionary phase. Okay, so when it breaks down there, I'm ideally, as soon as it does that, I'm looking for a shoulder, because the shoulder to me means that sellers are coming in at a lower move, at a lower level. Okay, they're not waiting for it to get back up there high. They're not trying to, you know, get out. It starts to fall. It starts to fall short of the highs from getting right back to get maybe a double top. Not all the time. It could get a double top. But generally that shoulder, when it's a trend, if it's a trend move down, you're looking for a lower high shoulder. If it's a trend up, you're looking for that high low shoulder. Okay, if that makes sense there. So shoulders are very important to me with my trading, especially when this move might be more on a macro, might be more of a macro move. Okay, so I'm just trying to trade those expansionary phases in red. Okay, trade the phase down, it starts to pull back, so the macro view hasn't changed, it's still a trend down, and I'm just trying to keep out of the green areas on the pullbacks and try to trade those expansionary areas in red, okay, with the trend. I'm not trying to keep, you know, load up long when it starts to go in that expansionary phase. And that's what it comes back to, knowing your levels, knowing the bias of the market, so knowing your anchors to the major move, okay, and trying to trade the correct leg. You're not trying to trade against a trend. You try to keep out of those contractive phases, because they can get really choppy, and they're basically there just to chop people in and out of the market. You know, just to drag people in, trap them, push them back out, drag people in, trap them, and push them back out. When you're in an expansionary phase, you know it, because the move down is going to be a lot harder, and the pullback is going to be nice and shallow. But when you get a pullback phase, it might go up, take out a minor, or in this case, take out a minor high, only by a few points, and have a deeper pullback on the way up. Okay, but when it's an expansionary phase, those pullbacks are very shallow, because the bulk of the herd, or the herd mentality, is down. Okay, and that's what we're trying to trade. That momentum is down. All right, so remember shoulders. If you go and look through a few charts, you'll see they'll start popping out, popping up everywhere, and then I think it's a really good way. And that's how I base a lot of my trading around. People know I'm always banging on about shoulders when we're trading shares, especially if I'm looking at the weekly. It's a nice weekly trend up, and it's a nice contractive phase. I love that sort of stuff. On a share, it's had a bit of a pullback, a lower high, lower low, then it starts to hold a high low, and it starts to break. To me, that high low, we've had a bit of a line in the sand where it's moved back, it's flushed out enough for those late buys into that trend up, flushed out enough, it's starting to reset, and it's starting to go again. And we're trying to get in off that high low, because to me, that's people moving up. They're not waiting for it to get down lower. It's sold enough that the sellers are starting to lose steam. Okay, they've done their selling. There's only a few sellers left that pushed it down and they stall. Okay, and then buyers have to start jumping in at a higher level, that high low. And it's just the reverse for a seller. That's where you get your shoulders come into play. And for me, it's a really key setup with your price action of what I'm looking for. And I'm trying to trade that at the right time. Yep.
Quick interruption again. The time frame is important. When you look at the chart we've got in front of us, what are you looking again? What sort of to identify this?
It's on anything really. So if I'm trading on a one minute chart, I'm looking at these pullbacks on a 1 minute chart, but the 5 minute might just be down. Okay, so the 5 minutes just a move down, a pullback, a move down, a pullback. But on a 1 minute chart, you can break it down. You get more detail, so you get these minor lower highs, lower lows on the trend and the expansionary phase down, and you get these minor higher lows, higher highs on the pullback phase. So it comes down to whether you're trading. If your trading time frame is a 1 minute and your anchor chart is a 5, or whether you're trading off an anchor chart of a daily and you're trading an hourly chart. So it's all, this kind of price action is what I'm looking for. So you can see, if you can look at this, if this was a weekly chart, for example, it'd just be that green would just be a pullback. Red might be a couple of red candles down, a couple of green candles up, a couple of red candles down. But when you break it down to your trading time frame, you get a lot more details, and that's where you're going to get your lower highs, your lower lows, your lower highs. So that's where you can identify your shoulder, start to getting nice and early. It might just be a single candle on the weekly, but on the daily, but it might be on the hourly chart, you know, a couple of green candles, a couple of red candles, a couple of green candles, and so on. So I'm trying to use that finer detail to trade from, but trying to trade the bias of the anchor chart. Does that make sense?
Yep, thank you.
Right, so that's the concept for shoulders, and I'll get into a few examples as well. I'll get to the next slide. So this actually here is an example of what I call an RTF. So an RTF, if anyone was there when I was speaking last, may be familiar with it. If you've listened to me talk before, you may be familiar with it. Some people might term it a double top, a double bottom. We call it a retest fail because it encompasses more than just a double top. You know, you might get a trend down, you get a minor, we call it a retest fail. It could be a minor double top, but I term double tops as different on a larger scale. Okay, so a retest fail, you can see at the bottom, I term that's essentially a triple bottom, but you can see that little minor one as this is the hang seng, so that you've got the open here when it starts to push up, has a bit of a pullback, then it pops up and you see a couple of green candles in a row, then you've got the first RTF. Everyone can see that. If you can see my mouse, you'll see I was highlighting it there, where it's only just a few candles, but you can see it's touched up to a high, it's had a red candle, then a green candle's pushed back up, and it's failed basically at the same level. Okay, it doesn't have to be exact. You're not looking for an exact. It could wick through and come straight back down. But I would term that as an RTF, but I wouldn't say that's a double top at all. A double top's more on a major scale. Okay, whereas the bottom, I would just term it a retest fail, but you can call it a triple bottom, or not really a double bottom, but a triple bottom in this case. Okay, so that's kind of a key price action I look for as well. And like I said, it doesn't have to be exact to the number or to the figure, but I'm essentially looking for that too in my trading. So if I'm trading on the way down, like in this case, we've made that high, the market's pushed down and then it's popped up and we've got those couple of green candles, then we've got that RTF below the previous high. I find that a very strong signal that we're going to head south, and I'll be looking for an entry setup. Okay, so this is a snapshot of the actual trades I did today, and just after I said that, I actually didn't take that prime trade, which you'll see I've marked up as a prime entry short. I did not take that trade. Don't know why. Maybe I was a bit late to the party and I just didn't hit the sell button. But that for me is a prime setup. You've got the market's popped up, it's made a high, it's had a pullback. Okay, it's fine. The market could be trending higher still, may go to take out the high, but then all of a sudden you fail at a lower level, and that's key. You're failing at a lower level. I've got a minor RTF, a retest fail on the cards as well. And then all I'm looking for is my entry after that when it starts to fail again. And that's, so what you're getting in that respect, you're getting traders that might have bought it on the pullback and it starts to head back up. And all of a sudden it's failing at a lower level. So all those buyers and potentially anyone that's bought it just previous on that first little kick up is having to reassess, and they're going to have to sell into the market. And that's where you get those those little moves that start to take out the lows and start to attack another level, which it did. It went straight back down to the low. So that was the first trade. I should have taken that according to my rules. I didn't take that, but I then took the very next trade, or the first trade for me, the next trade that played out was on the chart, it looked okay, but according to my MACD, which we'll talk about in a moment, I shouldn't have traded that, and I cut it fairly quickly once I got in, where I was excited. I got in, broke the low, it had my setup, the 3-candle setup, which we'll talk about, and then I stopped myself out for 20 points basically, and it did turn around and go back down again. And the second time around, there's nothing wrong with that trade. I lost 30 points, but that's just the nature of the beast. You can see it's set up all right. I'm going with the momentum. Price action's making lower highs. I can see that sellers are coming in at lower levels. It went down, I got in, and then turned around and reversed on me, stopped me out, and went straight back down to where I thought it might have gone. So you can see, just sometimes it doesn't work out, but that's why risk is so important. Now, after that, the trade that really worked out for me nicely, you can see that RTF. So when I get that RTF, you've got to question, why does it keep pulling up there? And when I get a flush, like you can see on that red candle there, when it gets through just where I've written RTF, it pops through and comes straight back again. Then we start to make higher levels. So that's the washout that I'm talking about, that I always look for, a flush of a level. It's a stop hunt. All those sorts of terminology is the same thing. Stops are getting triggered, and people are getting, there might be some breakout traders below there selling that breakout with their stop above. They all get trapped, okay? And then the market starts to reverse. So those sorts of things I'm looking for as well. I think that's a really good heads up. And not only that, what you've got is you've made a high initially just after the open, okay? Then you've made another lower high where the RTF is. It's come all the way back down. Then it's come back down where I got stopped out twice. It's made another, rounded lower high. Every time it's doing that, it's bringing in new sellers. It's bringing in new sellers. So it's bringing in more fuel for a potential reversal. Okay, so I've got to bear that in mind. And because of that second loss, the loss of 30 points, I was actually looking at it thinking, I reckon they're going to trap. They're just grinding down. If they flush the low and bounce straight back again, I'm going to be looking for longs. I'm going to look for a higher low to work off. And I didn't really like the first high low, but I did like that second high low, jumped in and made 70 points and 80 points just into those highs. And as you can see, it could have been a lot better than that as it kicked on through. But if you can understand the reasoning behind it, the sort of key things, I've marked up key levels where I expect some action or reaction. Okay, and there's certain things I'm looking for. I'm looking for a higher lower for the level. I love to see a flush through the level and a bounce straight back again. So that stop hunt that we're talking about, or the washout that we're talking about, and I like to see when a whole lot of sellers have come into the market, it's dragged more sellers in, okay, and then that's fuel to move the market, potentially move the market back up. And all I'm trying to do is jump in on a high probability setup with all that price action, all that evidence from what's already played out, and try to work it in my favor. Okay, so that's the action for today. So indicators that I'm looking at and what I use. I generally use a 10 EMA, exponential moving average, and a 20. Okay, I also use a 50. I can have it set up, but they're the two that I'm really focusing on. I used to be a 20 and a 50, and then use a 200. Then I've whittled it down to a 10, a 20, and I sometimes have a 50 on there as well. Sometimes have a 100 EMA. I look at those generally at the start to get my bias, to get my levels, to get which way I think the market could be going, and try to pick out my key levels. But generally, when I'm trading off the 1 minute chart, your trading time frame, I'm using the 10 and the 20 especially, because if I'm going to get it right, it's generally going to stay, the 10 is going to be above the 20 for a buy, below the 20 for a sell, and then generally you get enough of a momentum push, and it sticks to those 10 and 20 EMA with one below the other, and it's going to give you a good little payout. Okay, so I also use the MACD. Okay, I don't know if anyone used that, but I generally just use it. I don't use the crossovers or anything like that. All I'm really looking for is momentum. Okay, so it's more, I use it for a broader picture and I'm trying to trade around that zero line. Okay, if it's coming back into the zero line, it's a bit oversold. It's come back to the zero line, it looks like it's rolling over again. To me, that could be an expansionary phase back down again. Okay, so I'm trying to trade it around, give or take, say, I don't know, 15 above the zero line or 15 below, within that range. So I think when I get onto an expansionary phase, I'm going to get some sort of trigger when it's in that range. I won't be buying when it's overbought, when it's extended, and I won't be selling when it's extended to the downside, the MACD. Okay, I'm just trying to use that as a picture, as a frame of reference for my momentum. Okay. Also look for, like I just mentioned, I look for washouts a lot and extended markets, but it's got to be extended into a level, into a key level. All right. I'm not just looking for, okay, I think it's extended, I've got a lower high, I sell into that. It's got to be a reason, it's got to be a zone, okay? And it's got to be a distinct change in extended market, extended up. It's got to be a distinct change in the bias of the market where I'm trying to sell it into, okay? And it's not just a lower high, because it could be the lower high, but the anchor hasn't broken. So that's what I was saying before, the anchor is so important for me. If it breaks the anchor, then I get my lower high, that's great. If it doesn't break the anchor, I won't be trading off a lower high, because it could just be a couple of moves down, and that's just to sucker in and trap some sellers before it turns around and continues on up again. Okay, so there's certain areas where I would trade into an extended market, into a stretched market, generally off a resistance level or a support level, and I want that bias to be changing, okay, which means the anchor's broken. The anchor to a downtrend is broken, or the anchor to an uptrend is broken, okay? Love to look for trap traders too. Okay, like I just mentioned, if it flushes through a level and straight back down, you know that it's going to be buyers that have bought through that resistance and it's all of a sudden come back down. They're the first ones under pressure. Okay, they're going to feel the heat if they get it wrong, if it continues down, and the reverse for the downside. Always like to look for a market, like I've mentioned a few times already, when it goes into expansion. Okay, I'm always trying to trade into expansionary phase, generally when it's expansion on the anchor chart, like I mentioned before, and I'm trying to trade it off my trading chart, whatever that may be, right? But I'm always trying to trade in expansion, because that's where the momentum moves are. Even if it's trading on the bigger time frame, it might be trading in a range, it might be quite a large range, but you can still get that expansionary phase off a resistance within the range, and it's going back down to the support within that range. Because it's a larger range, you can still get that expansionary phase you're looking for as it starts to trend down, it starts to trend back up, and starts to trend back down. Okay, so but you've also got to know, you always got to know the major picture for the market, or your plan of attack, okay, and know where you are in the bigger picture. And like I said, I'm always trying to trade in the unknown, because if you're waiting for too much confirmation, the more confirmation you see and you wait for, the more confirmation everyone else is seeing, okay, and the less of the payout. I'd like to say it's a fact, but I think of it as a fact, because the more confirmation you're waiting for, when you feel comfortable for getting a trade, there's a good chance that you're at the end of a move, okay? So even though it's hard, you're always trying to trade in that area where it's unknown. We say it's unknown, and you've got the sweaty palms. You don't know whether you're going to be right or wrong, and it can really play on your mind sometimes, especially if you had a couple of, like today, I had 2 losses. But when I saw it, when you see it a bit clearer, when the picture becomes a bit clearer, you can go in, you might want to go in a bit harder. Sometimes if I see it clearer, I'll go in harder, okay? If I don't see it so clear, and I don't exactly know, I might just trade smaller size until I get more of a feel for the market, all right? But generally, trading in the unknown it's probably a lower probability trade, but the payouts are better, okay? And if you're managing your risk correctly, my stats sit somewhere around 60 to 65% right, 40 to 35% wrong, but those payouts are around about 1.5, okay, in my trading generally, 1.5 to 2 when I'm right. So you can see that's profitable. I know if I stick to my plan, I'm going to be okay, because I've got the stats to prove it. And I don't know if I'm trading in the unknown. Yeah, it might be hard. I might get stopped out a couple of times. There's going to be days I get stopped out 3 times. I'm done. I'm done for the day. I just wasn't seeing it, or I was in the wrong time. I was too eager, but I'm cutting my losses. I'm managing my risk correctly. Okay, price action defining key levels and key areas. You've got to build a picture. I think that's very, very important. Build the picture before you get into it. Even if it's shares, if you're a technical trader, you should be building your picture. Whether you start on a weekly, daily, you can work your way down. If I'm trading intraday, I'll look at the daily, have a bit of a glance at it, see what it's doing, and then looking essentially at the 30-minute chart, and then down to the 5-minute chart for my key levels, and then I'm just trading around the 5-minute chart and off the 1-minute chart. Okay, intraday when I'm trading the Hang Seng, the Nikkei. I don't really do the Dow, but if I'm going to trade the Dow, I used to trade the DAX. It'll be that same basis. Okay. But I'm always beforehand, I'm always prepping my anchor chart, okay? Putting my levels on there where I want to take, participate in some action, or I'm waiting to see what happens at that key level, where I expect an action or a reaction. Okay, if it's going to go up to resistance level, you don't know if it's going to blast through or if it's going to, you know, come back down off that level. Okay, so you don't just jump in. You don't. I would never tell people to just go, let's sit on the offer as it comes up to a resistance level. Okay, just don't sit on the offer because you stop above, because that's, to me, that's, I don't want to sound rude, but I'd term it as arrogance, because you're just sitting there saying, I'm going to be right. I'm going to go sit on that offer. It's not going to go through. It's going to come straight back down, and it's going to trade perfectly a few points through my entry and come straight back down. That's why you do get those washouts all the time, because the market knows people do that. It'll flush it through. You get stopped out and it turns around and you're right, and then you get the market goes all the way back down again, and you're not in the trade. That's why I'm saying about shoulders. Wait for the shoulder to play out on your lower time frame in your trading chart, and just wait for that action to play out, because you don't know if it's going to blast through. Like I said, it blasts through, it comes back and retests it. The resistance, it's now support. You could trade long off that, okay? Because now you've got confirmation it's going through. Or it blasts through, comes straight back down below. Then you've got confirmation it's probably a washout and you can go short, okay? But you've got to know your key areas and you've got to know how you want to trade them, okay? And you're looking for that action or reaction. All right, so what I've got here is actually it's just the trading from before, but I'm just going to describe that third trade and how I would approach that trade, okay? How I did approach that trade. So this is the trades from today. About now, I've already had a couple of stop outs and I've missed that prime entry, which I've described before, but we're coming up to why I'm changing my mindset. So originally I was looking for a short, and the first short didn't work out. I took myself out. The second short, I got stopped out, okay? But the bias was still down to me, and I've still got to trade my plan. I don't know if it's going to go blasting through that support. There's every reason why it could do. I don't know that, so I'm only going to trade what I'm seeing at that time. But in the back of my head, once we start getting that kick up, I'm looking for it going, oh, hang on a sec. To me, it's lacking conviction on the downside. Okay, so what I'm really looking for is three things. At this stage, I'm not sure what's happening, but if I see this kind of price action, it pushes down, holds another lower high, I might have another stab at it, because I know where my risk is now. I'm trading when it's coming down. I've got my risk above that lower high, and I want to see if it can break support. And if it doesn't, I'm going to get out pretty quick. I'm wrong again. Okay, so that's the first scenario. The second scenario might be where it pops up, has a pullback and flushes support. And then if it comes straight back again, I'm looking for that high low to work off. Or the third scenario could be we just blast off from here, and I get a higher low to work off. It starts to trend higher. Okay, I'm not sure what's going to happen. In my head, that's what I'm planning for, and I know what I want to see. I just got to wait to see it, or waiting to see more evidence. And as you can see by the MACD, I've got two yellow lines, which are probably on the next one's a bit better. There you go. Two yellow lines. So the MACD on the downside, the momentum's easing, and on the upside, it was easing as well. And now on this slide, you can see there's a clear break of momentum. Okay, buyers are starting to win. And what we've seen is a little bit more evidence. We've seen the flush to the downside of support. And then we've got a higher low. It's in that yellow circle area. To me, that's clear. Now I'm starting to see a reason why I should be getting involved in the long side. Now the picture's starting to become a bit clearer. And you can see by the only two scenarios I want to trade, and I'm not going to trade down, I want to be trading up. And I'm just waiting for that setup. All right. And like I mentioned before, I'm looking for a squeeze up. Okay, you've got lower highs coming to play. The pressure's down. Sellers have they're already in the market. There's a lot of sellers built up in the market. A level's holding. It's flushed at levels. It's dragged in some more traders on the short side, trap them because the market's starting to move back up, hold sort of minor higher levels. To me, that's the unknown. I should be looking for an entry there. Okay, and what we get just a bit later on is exactly where I'm entering here. So I've boxed that up. I want to it's bouncing off the MAs. I want my 10 above the 20, like I said. Momentum's starting to shift up. You can see the MACD's going from sort of that oversold zone below zero to above zero. I like to trade it when the momentum's going up. So momentum push up. I'm in an expansionary phase. I've got all my boxes ticked. It's just waiting for that entry. Okay, and the next slide there, you can see it actually kicked off quite nicely. All right, so that's the process of what I would ideally be going through. Of course, there's going to be times when you don't follow your process and you get a bit eager. Like the first trade, a bit of FOMO. I thought I was going to miss it. I jumped in short, and sure enough, I didn't miss it. I got stopped out. Second trade was fine. It just didn't work out for me. And this third trade, I've built up enough evidence, and there's all the reasonings why with the price action, why I feel this is going to go back up to that resistance zone, up to the highs. Okay, and you know, just as a reminder, you probably should just let it run. Okay, and like I said, I cut it into that resistance, thinking it wasn't going to go too much. So a mistake by my part, but you know, all in up, it was a profitable day. Okay, so we're on to the last area, which I still got about, I think 10 minutes ago or so, so I should be right for that. 3 candle setup entry. So this is one of, I've done some videos on this before. I think I've done a couple of videos on this. It's in YouTube. Check out the YouTube channel if you like. I term it the 3 candle entry setup. All right. What I learned it as, and what I also term it as, is a HH2 or a LL2, meaning lower low 2, high high 2. Okay, which I'll explain just now. So it's generally what I'm looking for. If the move is up, the bias is up, I'm looking off my trading chart, my 1 minute chart had a little bit of a pop up. First pullback, okay, not only the first pullback, but it might be later on, but I just don't want it to be too late in the trend because I think the probability starts to skew against me. Early in the trend, when I'm in the unknown, the probability is on my side. So what I'm looking for is essentially, if the move's up, you get a couple of green candles on the upside. And remember just to flip it over for the sell. It's the same thing on the downside. Just reverse. So a couple of green candles, then you get a couple of red candles. I generally like to see 2. Okay, and what I'm trying to work off, if that red candle is the low, it's actually even. The very next candle, it tags the same level, the low, but I'm working back. The next 2 highs from the low, okay, so that red candle you've got is the first high, which made the low, and the very next candle back, I'm trading through that high, okay? I'm trading nice and early before you get the breakout of the, I'm sort of front running a new high, if that makes sense. Okay, so the entries, not that first green candle after 2 reds, it's the very next candle. It breaks through, I boxed it up, my entry's through the high, my risk is through the low. If I get in and it turns around and reverses, I mean, so be it, I get out with a small loss, okay? I was wrong. I might have to wait for a deeper pullback, okay? But generally what I'm liking to see is this will be hovering above the MAs, okay? The 10 is above the 20. They're coming back to the 10, maybe the 20. I get this kind of setup. It starts to go back up again. I'm jumping in long, nice and early, and hopefully it's in the unknown. Okay, so that's basically what I term a HH2 or a 3 candle setup is what I like to trade. Okay, so we're on to some, here's just 2 examples. The first trade and the second trade, you can see them, that's on the 1 minute chart, the first one, and the second one. And here's on the 5 minute chart, okay, what it looks like on the 5 minute chart. So essentially what I like, if I want the 10 above the 20, which we talked about, okay, and I want the MACD to be biased up as well, okay. I just, as a reference, I set my MACD at 10, 20, and I have a smoothing, I think of it as 9, okay, for the momentum. So the MACD here is at 1020. It's basically going off the same EMAs. I set it to the same thing. And what I want is that MACD to be rising, okay? The 10 to be above the 20 EMAs, and I'm looking for that little minor pullback. And what I'm thinking on the 1 minute chart, that's a good 5 minute push higher, okay? The first one, you can see it started to expand higher, and I'm getting the MACD on my side for the 5 minute candle chart as well. Okay, so you can see it's gone to the oversold area. The 1 minute's already heading higher. That's that first trade here. That T1 is that first trade. Okay, it's about this zone here. The 5 minute's already started to push higher. On the 1 minute, is what I was saying before, that there's a couple of green candles on the 5, so 3 green candles in a row. But on the 1 minute chart, I'll get that minor pullback, and that's what I'm looking for. Okay, when the MACD isn't, you know, it's gone from oversold, it's starting to rise. The MACD is rising on the 1. The EMA, the 10 is above the 20. Ideally, you would like the 10 to be above the 20 on the 5 minute chart as well, but it doesn't have to be. It's more important that you go in with that 5 minute momentum. Okay, and on the second trade, you can see the MACD, as Kate had a bit of a pullback, it actually went sideways, the price. MACD's pulled back to that 0 line. We're starting to roll back up again. Now that trade, I don't think went too far. It might have made a new minor high, but really didn't go too far. But that was the second setup there. And you can see I've got a red candle, which made the low. So the higher that candle plus the higher the next candle is where I want to trade through, okay? So it's always off the low is where you take your candles back, all right? Hope that's making sense here. We've got a couple more examples. So if you can see this here, I've marked up everything that I'm looking for, okay? So basically the green area is ticked. I've got the 10 below the 20. That's your 3 candle setup. If you go down and look at the MACD, okay, it's in oversold territory. It's starting to rise. I don't want to sell it there, okay, because I could get flushed around. I could get chopped around, and lo and behold, you did get chopped around. The second one that actually set up, same sort of thing. So those first 3 there, you can see on the chart with the price section, everything was set up. Okay, I've got the candles in place. I've got my 10 and my 20 in place, but the problem is the MACD, the momentum's going from sort of that oversold area, it's on the rise. So it may, to me, what I see, it's not, the momentum's not in my favor. I could just go to retest the low. It might just be a trap, anything like that. I ideally want the momentum to be rolling down, okay? Like we've seen in those next two trades, okay, a bit later on. I haven't got green ticks on them, unfortunately, but those two next trades, you can see that the 10 is, on the first one, the 10 is not below the 50, but the price section is below. They're rolling down, it's coming off a key level. I could have traded on that one, and you can see that the MACD was actually starting to roll over. So, okay, that might have been nice and early. It did work out, but if you don't do that one, the second one was the actual setup, really nice, okay? So you can see a couple of green candles. We've got that spike, rejection, the 10's below the 20, it's moving down, price is moving down, the MACD is moving down, and it's nice because it's above the zero line. It's starting to move down to the oversold territory. And what I've got marked up in green is that on the MACD, I'll just mark it for reference between 15, minus 15 and plus 15. It might be different for different charts because MACDs tend to be calculated slightly differently, maybe on different software, but for me, on the TD platform, TD365, it's 15 and 15.
Braden, just an interruption again. I've got a question from the audience here. Just a second.
Yep.
Hi, Braden. Quick
Here
question.
you go.
How do you get out on these trades? Do you have a set target? Do you use MACD to show a loss of direction or momentum? Yeah, how do you actually pick your target that you're trying to get out for?
Yeah, usually I just reverse it. So if it's on that first trade, for example, where it actually worked out, I've got my setup. So that's called, you know, the LL2 or your 3 candle setup. Now, when it starts to go down, you'll see those candles are just expanding down, expanding down. So what I'm really trying to look for, and it's not just all out, it might be a partial exit, okay? I try to get that expansionary phase, and it's on a very short time frame, but I'm just reversing it. So if I see essentially a HH2, but not with the MACDs, sorry, not with the EMAs, you can see as you go down from that setup there, if you can see my mouse, it's gone down towards the blue support zone. You've got a green candle, then a red candle, another green candle. Then that third green candle, it's like a reverse HH2. So I might just get out there, I'll get out of a partial there. Or if it comes into a support area, I'll just take some off, okay? I like to take some off. I like to book a gain. If I'm risking 40 points on the Hang Seng, for instance, on a stop, I might want to take my first partial at 40 points. And if it doesn't really do too much after that, so be it. But at least I've booked something to cover the loss if I'm going to take a loss on the second half or the other partials as well. But generally, I trade in half or partials, 2 partials. Okay, so I'll be quite quick to get out of the first. If I get a nice little push, and that's when you start to see that momentum slow down, or you get a couple of red candles in a row, it takes out a couple of previous lows of the 1 minute candle. I'll get out of the partial quite quickly, try to book that gain quite early, and then I'll try to let it ride for the next partial and try to at least ride it into a resistance or a support zone. So it makes sense.
Braden, Peter here. This is all on 5 minute and 1 minute charts. So have you looked at it on higher time frames, for example, on a weekly versus a daily?
Yeah, I thought so. I might ask that. I was having a look at it today. I don't especially, but I did have a bit of a squeeze at it today, and it's, for me, it's the same sort of thing. Okay, you're looking at a similar type of thing. I think when you get a momentum move, the pullbacks in a momentum move, say it might be 2 green candles, or on a down move, or two red candles on an up move. Okay, it's a very shallow, because when it's starting to move in a certain direction, like I said before, the pullbacks are shallow, and then it might be just a quick 2 candle pullback, which sets out quite well for the 3 candle setup. But you want to be looking at off your trading time frame. So if you're trading, say it could be off a 30-minute time frame, which I have seen a lot that it does work, and then your trading time frame or your anchor chart might be your daily. Okay, but I just think it doesn't happen as often. It's more of an intraday thing. I find it works really well. It might be off a 5-minute chart as your trading chart, and off let's say a 30-minute chart, for instance, as the anchor chart. Okay, but it still works quite well. I find that because I trade intraday, I'm mainly looking off a 1 and a 5, and it works really well, especially for the Hang Seng. The SPY, I don't know if anyone trades the SPY, the ASX 200, it doesn't work as cleanly. I just think it's because the SPY doesn't have as high liquidity into the market. When it's got high liquidity, there's more participants into the market. There's more volatility, which is what you always like to see. And there's more algorithms too, there's more moves, and the moves are more controlled, they're better. And it's the same on the DAX. DAX works quite well. The Dow works really well as well, and the Hang Seng. And I use it on the Nikkei as well. I find that those setups work quite well on the Nikkei. And what it does by looking for those, for me, for looking this kind of setup, it keeps me out of trouble as well. If I don't see that setup, if I don't wait for it, it might be looking like it's going to set up. If I jump the gun too early, it may not have worked. Okay, and I'm actually on the wrong side of the market and I get stopped out. So if I wait for that setup and it doesn't work, there's a reason why it's not working. And it's going to reverse on me or something like that, or it's going to have a deeper pullback. All right, so waiting for that setup for me and for all the sort of back testing I've done, it works really well. It doesn't work all the time, but for me, it's a higher probability setup and it works more often than not. And as you can see on this chart, like I said, if I'm waiting for everything to sort of fall into place, at the start of the chart, we had 3 setups, but it didn't set up according to momentum. So I'm going to leave that aside. So the prime areas, it works quite well.
Braden, I got a question. On your chart there, the last cross, I can't read here. Is that 1320 or something? Or there's the last cross. Up the top there, I can see the moving average crossover between the 10 and the 20.
Yep.
But according to your rule,
Yep.
you enter if the momentum is up. It looks like, isn't it the MACD lines going up there, or why have you got a cross there? Yeah,
well,
where your
line,
cursor.
Yeah, so that trade there on the chart, on the price action, yeah, it's set up. And it actually did work out, which is a shame. But according to the MACD, it didn't work out. I wouldn't have taken that. But the good thing is, I could have taken something earlier, and if I was holding it nicely, I've held it through that anyway. So that, like I said, yeah, it does work out. The 10 is below the 20, which is fine. Price is above that, which in all essence is a deeper pullback than what I would like to see. So when I see something like that, with any luck, I'm going to get a shoulder trade just after it, which did play out just after that. Okay, and when the MACD was starting to roll down. Now, it didn't really go anywhere because it's late in the session. Anyone knows the Hang Seng, it has an hour break and then it opens up again. So generally come into that break, it doesn't do too much. The moves have already been and gone. So you can see.
But you wouldn't wait for the high, is it?
No, if I was trading, I want to be trading short off that, essentially. It's just the MACD that kept me out. Does that make sense?
Yeah, I think so. Yeah.
So you look at just that where I've got the cross previously, and you can see my mouse there. That was a really nice setup on price. Everything, it expanded higher. It's had a pullback. It's pulled back to the EMAs. The 10's above the 20. That's all great. Okay, we're going into a resistance zone. But if you're looking at that where you're coming off support and you're going to a potential resistance, you're sort of in the top half of that move. So you could be late to the trend. Yeah, it did work out, but the MACD wasn't in place for me. Okay, it was up, but I tend to want to keep out because I'm using the MACD for the momentum and also when that move could be getting exhausted. So that's why I've put across there just to remind me that I wanted to be trading within that green zone from the MACD. Okay, because that's where the prime area is going to be. That's where it's more unknown. And that's where you've got that earlier trade, okay, where the 10's just starting to cross. It's about where it crosses the, where I've got my cursor now, where it starts to cross the 50. MACD's fine. Yeah, it's starting to roll up. MACD's within, within that range that I'm looking for. It's below the 0 line. It's starting to, it's rolling up. So it's going above the 0 line. So the expansionary phase is just starting to kick off. So to me, that's where I would term the unknown. And it's the first, and you can see that white horizontal line that I've marked up there is the break of the anchor. So as I was saying before, that moved down, lower high, lower low, lower high, lower high, all the way until the most recent lower high was broken. It broke the anchor, had a pullback, made a higher low, all that price section, you add it all up, it says buy to me. I'm just waiting for the setup. And that's why, to me, I see that as a really prime entry area. And that's the beauty of getting in there. By the time you get to that second entry, it's getting a bit late. That move may or may not, because when you're looking at the hard right edge of the chart, you don't know whether it's going to go resistance. You don't know if it's going to make a double top or RTF there, and it's going to fail, come straight back down again. So that's why I don't like to get into a move a bit late. Okay, because for me, it's quite obvious it's going up there. Yeah, it could continue on. That's fine, but I don't see that as a high probability setup. And I think maybe, you know, the earlier trade, it might work 6, 7, 8 times out of 10. And you might get a really good payout. Even if it's 50-50, you're going to get a good payout off the earlier trade. Off that second trade there, where I've got the red cross, it may not work out as much, and your payouts are going to be generally lower. Okay, so if you're late to the party and you want to trade, that's fine. But just realize exactly, you've got to know where your risk is. You've got to realize that you could be getting extended. It could keep going, but it's a low probability that it's going to keep going. So I'm always thinking in terms of probability, whereas that earlier trade is the higher probability it's going to kick on, and the higher probability it's going to be a good move, because you're sort of coming off that support zone as well. Does that make sense?
Absolutely, yeah, thank you.
Fantastic. So that's an example there. Let's just go on to, this was a trade. I will be honest, I didn't trade this. It was a really, really good trade. I did see this. I think it was just after I just logged on the computer after that. It was on the Nikkei. But as you can see, the market's opened up. It opens up at 9:45, just before the SPY opens, just before the ASX opens. And I think they opened together. I think there's a 15-minute open for the index at 10 o'clock, 10 or 10:15. So the market's open, it's sort of flushed higher, but then the sellers start to come in, and you can see that. So it's above the MA, that original price action. Then it starts to go below the MAs. Okay, so when it starts to push below the MAs, you've got to be a heads up that we could be starting to get a shoulder trade, which I mentioned before. Okay, you don't know if it's going to happen, so you don't just go short because it's the MAs are rolled over. What I'm always looking for is that shoulder. Okay, because I think that first push down, okay, there's some sellers in there, but it doesn't mean they're going to win out. Okay, if it starts to pull back and then sellers start to come in at a lower level, to me that means that there could be a bigger move on play rather than just a trap that could be set. Like you come in here and it turns around, bounces straight back through the highs, makes a new high. Okay, on the 5-minute time frame. This is off the 1-minute chart, by the way. So what I'm looking for there, that's the LL2 or the 3-candle setup. You can probably just see the start of that box as a red candle. Then you've got the very next green candle. Green candle makes the high, so it's all at the same high. So I'd like to take 2 candles back from the first, well, the high point, which makes it that red candle, which is the low of that green box. That's where I'm entering short. My risk is above. It's a 45-point risk, which is about right on the Nikkei. I use generally about a 40-point risk, sometimes 45, if I think it could be a good move. And you can see that really started to pay out quite well. And I think yeah, I've got it down here. So if you followed that trend down, okay, we really didn't put you under too much pressure. You've got at the MAs all the way down here, all the way down here. We've got the low here, we've got a deeper pullback. So I may have taken some off at 50 points profit, which probably would have been somewhere in here or maybe just below that. And if I could have rode the rest down, what I'm ideally looking for, and this goes back to the other question about how do I get out, what I'm ideally looking for, if I've already taken a partial, I'm trying to let it go as much as possible. So I'm trying to look for the anchors. And that's where those anchors come in quite important for me, because if you start to get out, you just try to pick a low, pick a high when you're trying to trade it. You know, if you're trading long, you're trying to pick the high where you're going to get out, like I did today, or you're trying to pick the low where you're going to get out, and the anchor's not broken. To me, that trend is not over. Okay, if the anchor's not broken, the trend is not over. If the anchor breaks on this downtrend, for example, once the anchor breaks about here, where I should have got out, hopefully I would have got out if I'm trading it perfectly, because we've got the RTF, the market's moved up. That's the most recent lower high. MACD's the EMAs are still down. The MACD, importantly, is actually on the rise. So you know that it's running out of steam as well. Okay, you don't get out just because the MACD is starting to roll up. I mean, if you did get out, it would have been somewhere here, probably would have been the same price anyway, but there's nothing to say the market goes sideways, the anchor doesn't break, MACD starts to roll over again, and the market continues its way down, okay? And you shouldn't have been stopped out, but you've taken your stop out at a good trade. Okay, so once the anchor's broken on this first green candle, it pops up through it. To me, there's 2 things going to happen. It's either going to go sideways or we're going to have a pullback of that downtrend. This is the downtrend. We're going to go into a pullback or a contractive phase. Okay, so once we get that RTF, if I start to see that RTF, very big heads up that we're going to get a deeper pullback. because generally, sorry, question?
Yeah, Brendan, your anchor there, it's an exit for your short, but is it an entry for your long position?
Yeah, well, you could have done the exact same in reverse. So if I was quick enough, that first green candle would stop me out. So now we're breaking the anchor. So we could be, like I said, you're waiting for a market to go sideways, or you're waiting for it to go up. Now, the good thing is it's pushed back above the MAs, the 10's moved back above the 20. You've got the RTF, really good sign that we're going to at least get some sort of a pullback. And then I've got my 3 candles set up just after that, just after where I've marked it up. Now, it didn't really go too far, but you can see that if that starts to kick on, okay, I'm in a trade. So if I was not in that short trade, I'm looking at it. If it happens to be a really key support zone, then I would be looking for that kind of a setup with the RTF off a key zone. The anchor's broken, that move down is failing. Buyers are starting to step in. I've got my higher low in place, my 3 candle setup, and I'm going to go long. Now, whether it plays out or not, it's a different story. Okay, but the move was earlier on. This is just after the open. That move was down. I think it did start to grind higher. I think from here it actually continued to kick higher. This was only from maybe 2-3 days ago. So yeah, you could have definitely gone long there. Now, another good example on the Hang Seng. Again, I've just marked up the open of the session. 11:15, so that's that first red candle, pops down, had a bit of a pullback. 11:30 was when the index opens, it starts to go down, everything's set up. You can see that was a perfect trade. I took that, I didn't take that too far. I think I got out down here. I might have taken a final bit when it popped back up. I think that actually went down quite a bit more after that. I'm not quite sure from memory, but you can see the setup is there. 10 below that, it actually touched each other, but essentially the 10 is below the 20 EMA. Market's heading down. You can even see the hundreds, is on the downslope. We just bounced off a support. Now the thing is, are we going to go through support? Are we not? We've got the setup. We've got the MACD perfectly in place. Again, the 1 minute chart. You take the entry because you don't know what's going to happen. You don't just assume that it's going to bounce off support. You've got to take that entry. Okay, and that's the idea behind risk management. You take that. If it goes into that support and bounces straight back again, and we start to hold a double bottom or an RTF, okay, then I'm not taking too much of a risk. If we don't, that can start to open up to the downside, which it pretty much did. And I think if that's about 30 points stop, I think 30 to 35 in that case, that makes that move somewhere around 100 points on the downside. So you can see that there's quite a bit of fat in the move once you get onto the right side. You've done all your prep work, you've got your setup, all your parameters in place with your EMAs, your MACD, and you're on the right side of momentum rather than wrong side of momentum, and you go into that expansionary phase. So this is your open, contractive phase, expansionary phase down. Okay, some Dow examples. Now, this is just something I mark up all the time. I tend to mark it up. I keep it on file. I've got a Evernote subscription where I just keep taking snapshots of charts and put it onto the system just for reference. So if someday you get into yourself a bit confused or you don't feel right, I go back and review different things and go, okay, that's exactly what I want to be looking for. And it gets me in the right mindset or mind frame, whatever you want to call it. So you can see here, it's got some nice setups earlier on. Everything was in place. The MACD was in place. You've got the 3 candle setup played out quite nicely. Your risk is on the break of the top side. Your entries on the break of the bottom side of that box. You can probably see those. I've marked there's quite a few just here. There's another one here, which is quite large risk, but still, you made that low, a minor pullback, it takes out these highs. Okay, 2 candles back, this happens to be this low here, break through that low, your risk is above. I think that was quite large risk, but it still played out probably 1-to-1 at least before we start to get a retracement. Another one here, everything's still in place here. And if you go through and look at this section here, there was a couple of red candles here, then this green candle didn't set up, okay, it didn't trade, okay, it made a new high. Then the next push down didn't set up. So it didn't set up. So if I was taken out early, I could have got stopped out 3 times. If I waited for that setup to play out, it kept me out of trouble. And the third time, about here, you've got a couple of good green candles here, and then it turned around, the setup played out nicely. I've got my risk, now I'm in the trade, and you can see it's kept me out of trouble earlier because I was waiting for the setup, and it actually started to play out. But the problem is, you look down at the MACD and it didn't go anywhere. So I shouldn't have traded that anyway. But you can see by waiting for that the LL2 to play out, if it doesn't, it actually keeps me out of trouble. Right, so a bit later on, another setup here, but the MACD is not in place. Then we get an RTF. You got this setup here, and the MACD, I'd like to think that would have been in place, but it technically wasn't. But I do like to trade off the RTFs as well. You know, when I'm trying to feel a bit aggressive, when I see the RTF and the general basis of the trade or the bias has been down, if I see an RTF, I might jump in early, okay? Or I might wait for a lower high just in here, which actually there was no lower high play out anyway. So if I did take that trade, it was great. It worked out. I could have got some points off that, but I didn't take that anyway. And in essence, it actually turned around and come straight back again anyway. So moving along, you've got a setup here. Even though the 100 is down, you've got a nice, good move back up, and that's after a push down. So you've got a good sort of a flush down. The market's bounced straight back again, back up to the RTF level. And just prior to that, where the mouse is, everything was set up and in place. Now you could have taken that one. There's no reason why you can't. The 10's above the 20. It's starting to push back up again. You don't know how far it's going to go. You don't know if it's going to go back up and test these highs in one big move. You don't question it. You've just got your setup. You take that setup. In essence, it probably would have been more or less a break-even trade. By the time you got through this mess, you probably wouldn't have taken that. You should have really got out and seen, okay, that's not going to go anywhere. May have, at the very least, very most, a very small loss on that one. A bit further on, that trade there, the MACD is not in place either, so you've only got really one that's in place, didn't really go too far. Then we've got another RTF here. Here's sort of debatable because I don't mind seeing that as well. With the MACD, you've got that divergence there on the MACD. You've got an RTF, and I've got the 3-candle setup, okay? It's not a perfect setup, but you can see that did play out. And again, it's off an RTF, which I kind of put a lot of stock in as well, especially when I've got this kind of structure on the MACD. Momentum starting to fade. So in essence, what you got is a momentum push up, a pullback. If the market was strong, we shouldn't have paused here. We shouldn't have made that RTF. We should have just gone straight through. Okay, and that momentum would have been, MACD would have gone into new stretched levels or would have got a little bit more extended. But in essence, what you can see is that second move up, it made the double top or the RTF. Okay, momentum, that move up was weaker than the previous move up. Okay, but it only could get to the same level, couldn't get through it. So to me, that momentum, by reading the MACD, it just means there's less people involved in that move up. Okay, and more sellers coming in a little bit early. Okay, so I probably would have been happy to jump into that one, but yeah, I didn't trade this today anyway. So that was a good setup, but it wasn't the perfect 3-candle setup. A bit later on, I've marked a few up, but it was getting a bit late in the session. I generally like to trade this around the open. Probably the first hour or so, the Dow can move a bit, and then you might get some moves later on once it starts to work itself out. But generally, yeah, nice and early trading. And that's pretty much it. So is there any more questions? You can see the details on the screen there. There's my email address if you want to get a hold of me. Phone number there. That's a phone number that I don't always have next to me. I can give you my mobile as well. If anyone wants my mobile, just email that tradethestructure@gmail.com, and the website's down below. So jump on there, subscribe for free, and see what we've got to offer. So any questions, guys, about anything we've talked about? Anything I could recap?
Braden, I guess the last chart you showed us there, do you trade the start or timing wise, but do you play more any emphasis to where the support resistance, there's no support resistance there? Would you take the same trades, in other words, if they were close to support or resistance, if your RTF or your anchor was closer to those points or not?
Yeah, so I would have had this, I would have for sure had this all marked up. So the first thing I ever do with it, and I don't mind just doing it with a clean chart. I don't really look at the MACD much. I just would mark up before I trade the key levels where I think it could go to, or where I think I'm going to expect something to happen. Okay, so if this was where that first RTF was, if this is a major support zone, it probably would have got me thinking twice about it, because especially if there's resistance, if this move down is off a resistance area, you can see we're quite late into that move down. So the later we are into move down, the more we become, the traders entering that known area. Does that make sense? So everyone can see that's been moving down. So there's going to be people trading into there. There's going to be shorts jumping in early, anything like that. So if that was into a support zone, I may have thought twice about that, because what I'm weighing up in my head is there enough fat in that trade to get down there? Will it get down there? Because it has come from quite a long way already, okay, in one move. In one move, I mean, moved down, lower high, lower low, lower high, lower low, all that sort of thing. And we've got the RTF, okay, trading off on RTF, getting short, but there could be a support zone down here. So I'll probably, like I said, I'll be thinking twice about trading that one, or I probably would have waited for a lower high to trade off that one there, off an RTF, because a lower high means, okay, there's more, maybe there's just a lot more sellers to come, and I can jump in there and take advantage of it. So generally, I would put a lot of emphasis in the moves, especially on the Hang Seng. I trade that quite a bit, and I like the Hang Seng. Like today, I was basically trading it from a bid zone to an offer zone. Now, it did go through that, but that was the main reason why I cut it quite early. Well, not early, it was an 80-point gain, but that was the main reason why I cut it, because I was looking at it going, look, I'm up quite a bit. I've already taken a partial into the area, and then it started to pause. And I was in my head, I'm thinking, well, if this pops up above and starts to come straight back down again, it's a trap. So just trapping some longs, and we're going to come back down, and we're going to head back into that support zone. And because I've got that marked up already, I'm expecting something to happen there. And lo and behold, I took that off. It did come back a bit and then kept going up. So I got it wrong today. But yeah, if there was no resistance up there, I might have let that go a lot longer, because I'm looking for those moves where generally when you've got a good support zone, you've got a good offer zone, I call it, those moves, when they start to confirm that bid zone, they go bid to offer and vice versa. If it starts to confirm that offer zone, it's going to go probably to the next best big zone. Okay, so the market just wants to do that. It wants to put people under pressure. It wants to flush traders out, and it might be all part of a bigger move on a bigger time frame, but I'm just trading on that lower time frame. Does that make sense?
Yes, thanks. I've got a question on the chat box from Roy. Do you have a systematic way to run any back testing?
No, but I just do it all by hand. So every day, and it helps me see the trade as well. So if I haven't traded it, I will go through and mark it up. Generally, I'll mark it up anyway, especially the marks that I trade, the Nikkei, the Hang Seng. Like I said, I don't really trade the SPY. I used to dabble in it quite a bit, but the way my trading has evolved, I don't dabble in it as much. I just don't think it trades very cleanly. And to me, trading the SPY is more, it seems to be more guesswork for me with my style anyway. If I'm waiting for a shoulder, sometimes it plays out, sometimes it doesn't. It comes off a resistance zone. It can go up to resistance, come straight back down, and I don't get my entry set up. So I don't trade that as much, but I do mark it up if I see something quite nice. Okay, if I have seen it, I will mark up that chart as well. I just put it on reference because I think it helps you. I guess part of trading is seeing things over and over again, is repetitive. So if you're continually marking it up, and I've done that for years and years and years. I haven't done it every single day, but I'll go through periods that I might not do it, but I generally try to like to do it all the time. If I've traded, I'll mark it up and I'll write notes to myself why I was, what I was thinking. Was I thinking it was going to do this and I was completely wrong? Did I go against my plan? Like today, that first trade was stupid, and I'll write that up there. Shouldn't have taken that because of this, and I'll mark it up in the trade, mark up what I did. And so next time if I go and look at it, I might scan over it before a trading session. I'll just have a bit of a look what happened yesterday, take a look at what's happened in the past, and just refresh my memory and get your mind set for that, for the coming action, I guess. So I think the more you look at it, the better you're training yourself to see it ahead of time.
So your testing really is in real time, and I guess
real time,
you measure your performance by your success of your trades.
Exactly, and I do mark it up, but I haven't got anything to back test it. I haven't put up a system, or I know you can probably get an algo, or you can do it on maybe TradingView, but unfortunately I'm not that bright. I can't figure it out at the moment. But I think I would actually be really into it if it's could set up some sort of trading system to trade just off those setups. I think it'd be worthwhile.
Can you just explain for Raj the RTF, what it stands for?
Retest fail.
Thank you.
So you could call it, like I said, the double top, but I use it a lot more than just a double top, double bottom. You can see this first RTF, market's moving down. That's not a double top, essentially. It's just part of the trend down, but I call it a retest fail. So if you see move down like that, it's got to move down, lower high, another move down. It's made a lower high here. It takes out that low. Okay, maybe the market's not ready to go down yet. It comes back up. Okay, so at that stage, you're looking at that thinking, it's taken out the low, but it didn't go on with it. Maybe it's going to reverse. Maybe we've got the finish of that trend. It makes the RTF, all of a sudden, you've got more sellers piling in. Okay, so what it's really done to me, dragged in some sellers, it's dragged in a few buyers and probably dragged in some buyers here. They were under pressure, dragged in some more buyers. They might have got confidence from seeing, oh, hey, this is a double bottom. They were trying to trade it too early. All of a sudden you get that RTF and they all realize they're on the wrong side of the market, and then they all, I guess, puke their trade. They'll have to sell back in there pretty quickly. And that's why you get, as soon as I get that RTF, I'm looking for something where people are going to get caught. Basically longs in this case. And the same with this second one. You know, the market's popped up. It's gone through this first RTF, has a pullback. All this move here is dragging in buyers. Okay, dragging in buyers. They haven't been put offside yet. They're expecting that to continue high. As soon as you start failing at that previous high, and you've got a minor flush, if you can see that, a little minor flush, and it starts to roll over. Anyone through here has realized they're on the wrong side. Anyone that's happened to be lucky and bought it off that low, whether they've guessed or whether they had a setup, doesn't want to see their profit disappear. So they're all starting to sell into the market at the same time. And with that RTF, I see it as a strong move, and I'm looking for a setup there. So that's why I wouldn't say that's a double top, but I'd term it as an RTF specifically for that reason.
Excellent.
Any other questions?
Yep, we've got another question from the audience here.
Thank you. Braden, caller here. Thank you very much for your presentation, firstly. Now, can someone with practice trade this profitably on a CFD breaker with competitive spreads which are not fixed?
Yeah, yeah. So I do trade this on IG as well. So IG is not fixed, but they're generally, when I say fixed and not fixed, it's when the proverbial hits the fan is where you want them fixed. So when, and there will come another time when the volatility kicks up because we have a meltdown or the markets go crazy. It's just when the volatility kicks right out, they tend to widen the spread. So instead of going for 40-point loss, I might go for a 60-point loss. I'm going to have to, because the moves are also bigger. So I'm taking a bigger stop and I'm taking a bigger profit target. So I might be looking for a 150 to 200-point rally instead of, 50, 80 to 100-point rally. That makes sense. But if you're trading off a fixed spread, like I said, TD, and that's why that was been the whole aim behind TD, is to have fixed spreads. Look, it's not the world's best charting package. It does everything I need it to do, but it has fixed spreads. And I know from, working with Davin and working with the guys on the platform as well, that they stick to their word, and it's pretty good. So when you're getting others kicking out to 12 points and you're still at 5, say you're trading, what, $10 a point, what's that, another $70 that you're saving that's in your pocket, I think, in and out. So it is worthwhile, because that's, if you've got a profitable system, every time you're trading on the wider spreads that you're saving $70, yeah, that's really handy.
Okay, thank you very much, Braden. That was a very detailed. Oh, one more question. Sorry, we've got a few more questions to go.
No worries. Anytime.
Hi, Braden. George here again. With the trading package we're looking at now, or the chart, is that through TD365, or do you use a separate one for your analysis as opposed to your trading?
No, that's TD365. So that's the charting package there. It's just a CFD package. So they trade all your indices. They don't. TD365 doesn't trade share CFDs in Australia because of the licensing, but it's got much better margin than Trade Direct 365.com.au, which does trade CFDs on the shares. But they both trade foreign exchange, they both trade crypto, they both trade indices, oil, gold, all that sort of stuff. And it's the same spreads, everything's exactly the same. But I also use, to answer that too, I use TradingView a lot as well. I find that really handy.
Oh, Braden, just so I can clarify what you just said. So you're actually with the Bahamas-based TD365 rather than the Australian-based one?
Oh, we do both.
Pardon?
We do both. So
you do
TD365, Trade Direct 365, same company. Davin runs them both. I'm working with Davin on both, but they're basically TD365 come about because of the changes to the regulations with ASIC. We just gave people that, I think now all you can have, the higher margin is for sophisticated investors. Now, I've always thought that's a bit weird because sophisticated investors lose as much money because they're trading bigger. They're just as good or bad traders as anyone else. So there are people that are not sophisticated. They don't come under the banner of sophisticated, but they know how to trade. Okay, so really that's why we brought about TD365, because it's got the better margins under the different regulations. But essentially, the platform's by the same people, the companies are the same people, everything's the same. The money's held over in what is it, UK somewhere, I think, coming with a big bank, Barclays.
There's a question there from Martin. You mentioned 40-point stop was about right for the Nikkei. How do you determine what is right?
Okay, it's a lot of it's through experience of trading it, but a lot of it comes to like that trade I actually showed you before. It was about 45 points. Okay, but I want, like I said before, I want to be above or below the higher low or the lower high. Okay, so if I'm trading that LL2 or HH2 entry off where I expect it to be a lower high up here, if that happens to be 60 points, I probably won't trade it because to me that's too big. But again, it depends on what the volatility of the market is, because if that's a 60-point stop, it means this moves down is a lot bigger. But generally, that 40 points gets me at a zone where I'm going to be proven right or wrong. Okay, so if I do get into the trade and I've got a 40-point stop on the Hang Seng, generally that's going to be above a level where if it goes there, it stops me out, the market's reversed. But if it holds the trend, which I think is going to be the trend, well, that stop is going to be okay. Okay, so if it does sort of chop around a bit, it holds the trend down, I'm not going to get stopped out by being below a lower high. Does that make sense? So essentially it's from marking up the charts, experience, you know, so if I was trading a 20-point stop, I was getting chopped out a lot, but being on the right side of the market, I just have to move it out and trade less. Okay, but so it's all about what the price action's saying, not how much money you're going to make or anything like that, or how much you're risking. So if I want to risk, say, $400 in any trade, that $400 in when I'm trading the CFD has to put me outside of the high, lower high, or lower high. Okay, so if I'm going to get stopped out and lose $400, I've got to be proven right or wrong. Sorry, proven wrong, not right. Does that make sense? So if that $400 means that I'm going to be below, if I'm going short, say at this first trade, and I'm going to get stopped in here, and I want to risk $400, but I put my stop because how many contracts I'm doing, and my stop ends up being only 20 points away, I won't take it. I'll just have to move it down.
That makes sense.
Oh, no. So I just read the next question. ATAA, I don't use that. I use the chart specifically.
Okay. And just a quick question for me to close off. I guess you said you don't trade the Dow. You got the Dow on here, but is that because of the time frame, the long end of it?
Yeah, pretty much.
I find the Dow very predictable. I find that more predictable.
Yeah, the Dow's great. I think it's I used to trade a lot, so I used to sit up and trade the European session and into the US, but I was getting up out of bed. Getting out of bed quite late, but when I had kids, it got a bit harder to get out of bed late, so it got really hard to sit up at night, especially when you're at daylight savings time, where it kicks off at 1:30 in the morning. I can't be trading at 1:30 in the morning now with two little kids running around, so I tend to stick to the DAX, sorry, not the DAX, the Hang Seng and the Nikkei, because it's the perfect time for me. I'm by myself at home, kids are at school. I'm seeing quite a few trades, and the Hang Seng can move like a rocket when it wants to. And if you're on the right side of that move, you don't have to think about it. You get 100 points up your sleeve quite easily. And the 100 points with a risk of 40 can be 2, 3 to 1 trade quite easily. I mean, it doesn't happen all the time, but getting a 1-to-1 trade is quite easy on the Hang Seng because it moves. It's like the Dow. They're high volatility. The DAX can be high volatility. Lately, it hasn't been, but all those three are very high volume as well, where the SPY just doesn't do the volume that everyone else does. So I don't tend to trade that, but I probably will be getting into Dow. I think we're going to do a new Discord channel, which will be trading European and US session as well. So we'll see how that goes, whether I can last that long.
Okay, we're out of time, Braden, and we appreciate
worries.
your time. It's been very informative. I think we've all enjoyed your presentation. And for those that want to have a review, I know you've got some interesting videos on your trade to structure website, and obviously your contacts you put on there, trade to structure. Yeah, there's a few interesting videos on there which represent all your different patterns you've explained tonight. So thank you very much again for your presentation. This video will be on the website or on our website, on the resource website for anyone that wants to have another look. Thank you again and good night to everyone. This is the end of the online presentation here in this room. We are due for a coffee break. Thank you.
Cheers, guys. Thank you.
Thank you, Braden.